Okay, good morning, everyone. Welcome. We're going to go ahead and get started. Hope everyone's summer starting out well. We're at the top of the hour here, and welcome to our today's webinar, where we have a special guest, Michael Whitecall. We're thrilled to have Michael back. If you joined us last year for Michael's presentation, we all got a really great presentation, lots of really valuable information. I'm looking forward to hearing what Michael has to say this morning. Before we begin, I have a few housekeeping items to cover. We will be offering CPE for today's presentation. So those of you who need the CPE, please make sure that you complete the 3 poll questions that we'll have scattered through today's presentation, and we'll send you a CPE certificate in the mail, probably within 3 to 4 weeks. We also will be allowing some time at the back end of the presentation for you to ask questions. So please use the question feature in GoToWebinar, and we'll try to get all those addressed at the end of the presentation. And if there is any left that we don't get to, we'll try to get those answers to everyone that joined us and sent out. We will be supplying a PDF copy of today's slides, and we are recording today's presentation so that if you have any of your colleagues that would like to see this at a later time, we'll have that up in the coming days. Without further hesitation, I'd like to introduce Michael Whitecall. Michael's an internationally recognized economic and geopolitical forecaster who helps business leaders and policymakers and the wider public understand the issues and trends impacting the world today and what will shape the world in years to come. He is the president and founder of International Strategic Analysis, a leader providing economic forecasting and international market intelligence to leaders and clients around the globe. Thank you for being here this morning, Michael. We look forward to your insights. I'm going to go ahead and hand it over to you, and we'll get started.
All right, well, very good. Well, good morning to everybody. It's nice to speak to everybody again. I'm going to share my screen here, so just please let me know if, in fact, you can see the presentation.
We can.
If you can, great. Then we're ready to get started. So, what I want to talk about today is the health of the global economy, both now and going forward. If some of you probably attended the event we did late last year, this will be a follow-up on what we talked about then. There's been a lot of developments going on around the world. A lot of the same developments that were impacting the economy late last year continue to have a residual effect. In fact, some of the events of the last few years continue to have a significant impact on the economy, both in the United States and around the world. For those of you who don't know what ISA is one of the world's leading economic and geopolitical forecasting companies. So if you'd like to learn more about what ISA can do for you, you can visit our website at isa-world.com, or you can contact me at any time for more information. So what are we going to talk about today? We're going to talk about where the economy is right now, because there's a lot of very big issues continuing to impact the economy right now in June 2023. We're going to look back at how the economy got here. Again, we are continuing to be impacted by the events of the last few years, particularly the disruptions caused by the COVID pandemic and by some of the geopolitical issues that are happening around the world. We're going to look region by region around the world to see where the economy is going. We'll look at some of our 5-year forecast for all of the world's regions' economies. We'll talk about some of the big overlying issues that we touched upon back late last year. Those issues continue to have a big impact on the economy, especially some of the developments we've seen in recent months have just reiterated the importance of some of those issues on the global economy. And then for the last 15 or 20 minutes, we'll have time for Q&A. So I would be happy to take any of your questions. If you can think of a question today, I'm happy to answer it now. If you think of something at a future date, I'll have my contact information up later. You can contact me with any questions that you might have about the economy. So the state,
We're-
excuse me. No,
Michael, we're going to go ahead and do our first poll question for those who need continued professional education.
Yes.
And the first question is on a scale of 1 to 5, 5 being your most optimistic. What is the extent of your optimism over the U.S. economy over the next 6 months? Please go ahead and select 1 through 5, and we'll see what those results are, and then continue with Michael's presentation.
I've picked a number in my head. I'm curious to see how close it is.
Okay. All right, there we have it. About 53% of you believe your optimism is a 3. That's kind of what I was expecting. How about you, Michael?
Yeah, I was guessing between 2.5 and 3. So
Okay.
pretty much exactly where we thought.
Yes.
And
All right, let's move on.
That's an interesting result because it really does show just how uncertain things are right now, and it shows how we can go in a number of different directions. I've been doing presentations like this for over 20 years, and I would have to say this is probably the year with the most uncertainty as to the direction of the economy. We know when typically we know when it's going to be a difficult year, when it's going to be a bounce back year. This is a year that can really go in either direction, and you'll see a data release come out one day which is positive, and then 6 hours later another one which is negative, and we've been dealing with that since late last year. So it's made this quite a challenging year to forecast, and that poll result just reinforces that. So let's get my screen out of the way. There we go. So this so everybody can see. So what are we going to talk about? We're going to talk about the state of the global economy in the coming years and look at some of the results from recently. Now, if you'll remember this slide from the last presentation, I just want to reiterate the year of COVID, 2020, was the worst year for the global economy since the Second World War. The economy shrank by 3% globally in 2020. That wasn't as bad of a result as we thought when COVID hit, but it was still the worst result in many generations. We had a very strong bounce back year in 2021. The global economy grew by 6%, the highest rate of economic growth for the world since the Second World War. 2022 was continued a bounce back, but we saw a significant slowdown in the second half of 2022. That slowdown, for the most part, has continued in many major economies in the early part of 2023, and we'll touch upon some of the reasons why that is. But it's important to realize, again, and I always have to stress this, it's very hard to look at a specific quarter's data or even a specific year's data in the wake of the COVID-19 pandemic, just because its disruptions were so great. Its disruptions were akin to a global conflict. So it's important to keep that in mind. And that's why when you see some of my charts, we're going to be looking at multi-year results rather than a single year result, just because the numbers are so skewed and have been going back over 3.5 years now. Here's a good example of that. This chart shows just how the US economy has performed against other wealthy countries over the last 4 years. Remember, in 2019, the global economy was already headed for a slowdown. So you can see the US economy has grown by almost 2% per year through the COVID years. That's not a great result historically, but it's kind of, when you compare it to our contemporaries, other wealthy countries in the world, it is a pretty strong result. So almost 2% growth. You look at what happened in Europe, growth of maybe 0.6, 0.7%. You look at Japan, whose economy shrank over those 4 years. So yes, very challenging time, but in relation to other countries, the US has withstood the pressures of the COVID-19 pandemic better than most other major economies. Emerging markets also suffered significant disruptions. Those growth rates for emerging markets over the last 4 years also relatively below average, certainly below where they were before the pandemic. And particularly those countries that suffered big disruptions during the pandemic suffered the biggest losses. So as you can see there, a relatively disappointing result for many emerging markets. No matter what the presentation, I show this slide, I have to reiterate this all the time. The blue line on this chart is average economic growth rates per year in the world's wealthy countries. So North America, West Europe, some East Asian economies. 2 generations ago, we grew more than 4% per year. a generation ago 3% per year, and in the 21st century, less than 2% per year. This is the big challenge facing any type of company, manufacturing companies, service companies, when their primary business has been in the world's wealthy countries. So if it's North America, if it's Europe, if it's Japan. In the 21st century, a lot of that downturn was offset by emerging markets, particularly emerging markets in Asia, but that growth is also starting to slow. So the big issue here is how are we going to generate growth in the future when we're seeing lower rates of economic growth in the rich world, but also when in many emerging markets that growth is slowing as well. I won't dwell too much on this. It's just simply to show that this is happening across all different economies. What of course has happened, and I show this slide in many of my presentations, Asia's been coming back. A lot of the growth in the 21st century is being generated by Asia. Asia's total share of global economic output at the end of the Second World War was less than 10%. Today it's 40%. So growth is being generated in Asia. It's growing. It's been generated unevenly, of course, and we're seeing slowdowns in significant economies in that region, which we'll talk about later. But nevertheless, if you don't have a presence in Asia, you're really missing the #1 opportunity for growth from a geographic perspective in the 21st century. And this isn't going to change. Growth is slowing, but because of the vast size of Asia's population, it will continue to account for a significant share of additional global economic output in the years ahead. So if we look at where we've come from, obviously, we've seen a slowdown in the world's rich countries. We've seen emerging markets pick up the slack for that, but nevertheless, pretty much all major economies are now starting to face some increasing headwinds. And some of those headwinds we're going to talk about right now, some of the major issues facing the global economy this year, some of the things we've been talking about for the last couple of years, because some of these issues have been with us now for some time. Of course, geopolitical tensions are at the forefront of a lot of this. We have, of course, the war ongoing in Ukraine, which has had a major impact on the global economy. Its impact perhaps wasn't as great as had been feared initially. I'm thinking of an economic impact, but nevertheless, the potential for more impacts going forward is substantial. We'll talk about that in a second. The other big geopolitical issue, of course, is the relationship between China and the West. We've seen a very significant deterioration in the relationship between China and the US. We're seeing the Chinese-European relationship deteriorate as well. This has potential ramifications that are massive for the global economy. We're seeing investors starting to look elsewhere as opposed to China. We're seeing companies thinking about reshoring, bringing manufacturing back either to their home country or to other low-cost manufacturing centers. This is having a massive impact and will continue to do so in the coming years. That relationship between the West and China is going to have a profound impact on the global economy, on the manufacturing sector for years and decades to come. And it's not just external issues, there are internal political divisions as well. We see that here in the United States, we see that in many parts of the world. We are increasingly divided internally, and that's making it very difficult to formulate policies, particularly economic policies, to deal with some of the challenges which I'll lay out in the next few slides. Of course, the war in Ukraine is ongoing. The Ukrainians are launching a counteroffensive at the moment. We don't believe it is the primary counteroffensive. We haven't seen a commitment of the main armored units of Ukraine's armed forces yet. But they are starting to launch offensives in eastern and southern parts of the country, and so far they've made very little progress. If anything, this conflict has shown that if you study geopolitics and you study warfare, you'll know that there are periods of time when the offensive is in the forefront, where technology allows offensive military actions to have an advantage over defensive. Think of the Blitzkrieg in the Second World War. And then you have other times where the defense is very much in the ascendance. And we saw that, for example, in the First World War, where it does look in this conflict a lot like the defense is in the ascendance. We've seen both the Ukrainians and now the Russians be able to defend staunchly, be able to defend territory, causing great costs to the attackers. And the Ukrainian armed forces are finding out that right now. So this is certainly something to keep an eye on as this counteroffensive continues in the months ahead. Now, of course, this has had a big impact on the global economy, obviously on Russia and Ukraine's economy, but also globally. It had a major impact on commodity prices initially. That impact has lessened, but it still has the potential to substantially impact commodity prices going forward, particularly food prices. There's talk that Russia will bring an end to the deal that allows Ukraine to export grain and fertilizers through their Black Sea ports. If that happens, we're going to see a major surge in food prices, particularly in emerging markets. So that's something to keep an eye on, especially when we talk about inflation in a little bit. A big economic issue that we're dealing with right now is the labor shortages that are in many major economies. The unemployment rate in the US, of course, just 3.7%. As you can see from that chart, many major economies have unemployment rates that are well below their previous averages. This is here to stay. This is something that was beginning well before the COVID-19 pandemic and is going to continue for the foreseeable future. Because we have shrinking working age populations, which we'll talk about a little bit later. We have changing attitudes towards work, both among younger workers and among older workers. And we're seeing certain sectors of the economy really monopolize talent these days. So these are all factors that are leading to these remarkably low unemployment rates that we think are going to stay in place for the foreseeable future. So labor shortages, we've had this supply chain disruptions. Now these have eased, fortunately. We talked about this late last year. We had already seen an improvement at that point. That improvement has continued. And that's good news for the global supply chain. Of course, there are fears that the disruptions that we saw during the height of the COVID-19 pandemic can come back. So this has led many companies to start to reconsider their supply chains and their logistics setups. And that's something to watch going forward as well. Of course, inflation has been the dominant economic theme of the last couple of years. Inflation rates have been well above their average. We've seen the highest rates of inflation in places like the US or Europe in the last 30 or 40 years. Now, fortunately, the headline inflation rates have fallen in most major economies in the last couple of months. That's due to lower energy and food prices. But core inflation rates, and that strips away food and energy prices, they remain dangerously high. And that's why we're starting to hear many central banks express their concerns that core inflation could remain persistently high. Now you see those inflation rates in the chart on the right. Those are much lower than where they were when I talked to you in late 2022, but they're still well above most central banks' targets, which typically are around 2, maybe 2.5%, depending on the economy. So you can see inflation remaining a concern. And what does that mean? That means that interest rates that we were hoping were going to come down in the coming months probably aren't going to come down as fast as a lot of people had hoped for. And we warned, if you remember what I said late last year, people were already, a lot of people in the news were talking about interest rates were going to be cut in mid-2023, maybe the latter part of 2023. Central banks weren't saying that. No central bank was saying that they were prepared to cut interest rates. And now, even with the fact, for example, in the United States, that they didn't raise interest rates in the latest opportunity to do so, they did hint that there's another interest rate forthcoming. Why? Because that core inflation remains disconcertingly high. And there are concerns that that will have a long-term impact on the health of the economy. So while some smaller central banks have looked to cut interest rates, in fact, most major central banks may well raise rates at least one more time. Certainly in Europe, they're going to do so. There's a possibility in the United States that will occur. And that means that we probably won't see rates being cut until that core inflation rate comes down to a level acceptable to the central banks. We've seen debt go up, of course. During the pandemic, we saw a surge in debt in 2020. The landscapers are chasing me to this room, but I think they'll be away in a second. I hope you can hear me through them. But this is a big issue going forward. If you remember what I've talked about in the past, debt is fine as long as you're generating growth. But as we've seen, you look at it from a public debt standpoint, some emerging markets have found themselves in debt crises because they have accumulated such high amounts of debt, and they've either run out of foreign currency reserves or their economies aren't growing or both. And so we're seeing a public debt sector crisis in many emerging markets, and we're also seeing a private debt crisis in many sectors, whether it's the Chinese real estate sector, whether it's the US banking sector. So both public and private debt have risen to dangerous levels. And if we're not generating growth in the coming years, we are going to see a lot more debt crises in the years to come. So the takeaways from the key economic issues: geopolitical tensions remain dangerously high. This is no time to ignore what's happening politically. This is going to have an impact on the economy going forward. Labor shortages are in place and they're here to stay. These are not going to disappear. For some parts of the world, this is going to be a major drag on economic growth. I'm sitting here in Ohio today. It is the #1 issue in the state of Ohio, for example. The manufacturing sector, other sectors really struggling to find enough workers to meet their goals for growth in the future. Supply chain disruptions appear to be over, which is good, but there are still concerns about supply chains. Inflationary pressures, they're in place, particularly core inflation. We do expect that to ease, though, towards the latter part of this year. Interest rate hikes will eventually come to an end, but we might see one more cycle of rate hikes in the US and maybe 1 or 2 more in Europe. And debt levels remain a major long-term threat to the global economy, and they've risen substantially in the last couple of years.
Michael, we have another poll question for those of you who knew CPE. That question is, how has the state of the global economy affected your firm's growth over the past 12 months? I'll give you a moment to answer that question. We'll get the result. Okay. Yeah. Forced to scale back somewhat, leading. Not surprised by that outcome. I am a little surprised that a third of you indicate that you've not been unaffected. Good for you. I hope that continues. By the way, before we continue, I'll also indicate, please, drop your questions into the chat so that we can address those at the end of our presentation. Michael, do you have any comments on this? A little surprising that a third of the folks are unaffected thus far.
Yeah, it depends. Some sectors of the economy have done quite well, quite frankly. So that's not that surprising. This has not been an across the board downturn or slowdown. We've seen some sectors of the economy badly impacted, but we've seen others come through these last few years pretty healthy. So it's not as surprising as you might think. And other historical downturns, the downturn was really across the board. This has been sector by sector, industry by industry, and so that's not that surprising. Okay, well, good. That's I'm very interested to see the results of these poll questions. I really do enjoy that we throw those into the presentation, because it is very interesting from my perspective to see what the audience is actually living. It's one thing to present the numbers and what's going on, but to actually see how it's impacting individual businesses is quite interesting to me. So let's go on. That's where we were. What I want to do now is go region by region and just talk about look at our firm's forecast for regional economic growth in the coming years. And there's some pretty big disparities here. Not only has the events of the last few years had differing impacts based on economic sector or industry, it's also we've seen very different performances region by region. Some regions have done better, certainly done better than others in recent years. So what we'll do is we'll start right here in North America. Let me explain the chart on the right. The blue line is the average rate of economic growth in a country over the last 5 years. The gray line is the average rate of economic growth in that country, our forecast growth over the next 5 years. So let's look at the US just to explain. over so the landscapers drive right below my window. The last 5 years, the US economy has grown 2.1% per year. That's really in line with where we've been in the 21st century. In fact, slightly better. In fact, the US economy has done a little bit better in the 21st century than most other major developed economies. We're forecasting growth to remain relatively near that, 1.9% per year. So this isn't, for again, a lot of people in the US think that the health of the US economy is rather poor. When we look at it from a global perspective, the US has done pretty well. Why is that? The US has a very strong position in many high-tech sectors. High-tech sectors are clearly growing significantly faster than other segments of the economy. The US, certainly the shale oil and gas boom has had an impact on the US. And the US continues to attract a lot of investment from abroad. In fact, the US has now been the leading recipient of foreign investment for the last 11 years. But it's been a decent performance, all things considered. Despite all of the disruptions that the US has faced, it's been a pretty good result. Canada as well, not doing too badly, growing a little bit less than 2% per year. As we look over the near term, clearly the US economy is facing the threat of a very mild recession. We think the US economy will likely just be able to avoid it, but nevertheless, the near term, probably a little bit of a slowdown, but as we get into the middle part of the decade, we expect growth to get back around 2% per year. So a decent result. Again, far from where we were a couple generations ago, but in the international context, not that bad of a result. If we look south at Latin America, now no region has performed worse economically than Latin America over the past decade. In fact, most of Latin America's largest economies have generated very little growth over the last 8 to 10 years. We've seen multiple recessions in Brazil. We've seen very little growth in Mexico. Argentina has bounced from crisis to crisis. Venezuela, of course, has seen an economic collapse. As you can see from those forecasts, we are expecting a little bit of a bounce back in some of the major economies. But again, for emerging markets, these growth rates are pretty disappointing. One thing we're looking at is politically, right now, all of Latin America's largest economies have left-wing governments. It's the first time in history that the region has been so dominated by the political left. And that's led to a major change in investment policy, economic policy, social policy across the board in Mexico, in Brazil, in Argentina, and Chile, et cetera. And this is a region that is just not generating the levels of growth that we hope. Mexico is a perfect example. Mexico, despite its amazing position in North America, having access to the US and Canadian markets, has grown by just 0.4% per year over the last 5 years. And we're seeing what growth there is in Mexico is almost all concentrated in the very north of that country. Despite the efforts of the government to bring more investment into southern Mexico, pretty much everything is still going into the northern regions of Mexico. So that's something to watch, particularly from a US perspective. If we cross the ocean and go over to Europe, the European economy also struggled significantly. The US economy has grown almost 2% per year in the 21st century. The European economy has grown by 1.1% per year in that time. So a much lower rate of growth in Europe at the moment. Again, it's the larger economies that have struggled. There are pockets of growth, particularly in more high-tech regions or more export-oriented regions of Europe. But in other parts, we've seen pretty sluggish growth. And this isn't likely to change. Now, the good news, of course, there was the energy crisis. There were fears that the cutoff of Russian energy to Western Europe would lead to a significant recession. Europe is in a recession at the moment, but it's quite a mild recession. And that's good news. So as bad as the situation may be, there were a lot of economists who feared it could be a lot worse. Last winter was extremely mild by European standards. They were able to cut energy demand, and that really helped them to avert what could have been a significant crisis. Nevertheless, looking forward, as you can see, we're not forecasting very fast growth in the coming years. Growth, it is, but it's relatively sluggish, certainly when compared to North America. If we move east and we look at Central and East Europe, Central Europe had been doing quite well. We've seen a significant slowdown in many Central European economies. They've been dealing with very high rates of inflation. In fact, inflation topped 20% in many countries in Central Europe. With the exception of Hungary, it started to come down, but inflation remains relatively high. And then, of course, in Eastern Europe, so we're talking about Russia, Ukraine, Belarus, obviously the conflict that's underway in Ukraine has had a devastating impact on the economies of that region. In fact, Ukraine's economy contracted by almost 30% last year, so a tremendous loss. And the rebuilding of that country, we're talking about hundreds of billions of dollars. So that's certainly something that will be on many countries' radars once that conflict hopefully comes to an end at some point in the future. If we look south, the Middle East and North Africa, many economies in this region, of course, remain dependent upon the price of oil and gas. So when the price of oil and gas was high, these economies recorded high rates of growth. In fact, no large economy grew faster than Saudi Arabia in 2022, thanks to the high price of oil. Now, oil prices have come down this year, leading to production cuts by Saudi Arabia and other countries. But nevertheless, we're expecting some growth in those countries. And of course, this is a region that remains beset by political unrest. We've seen some progress there. We've seen a kind of a normalization of relations between Saudi Arabia and Iran, for example. The Chinese are playing a much bigger political role now in this region, trying to broker peace deals between rival factions. So that's certainly something to watch going forward. If we can get a higher degree of political stability in this region, we'd expect much more investment to go into this region, the diversification of the region's economy to go forward, and perhaps higher rates of growth going forward. If we move south to sub-Saharan Africa, this has been a region that a lot of companies are looking at for long-term growth. Why is that? Because this region's population will expand by 1 billion people by the year 2050. So we've talked about labor shortages, which are a big problem in most major economies. Here you're going to have a labor force that's growing at an incredibly rapid pace. In fact, this region's population will go from 1.4 billion today to 2.4 billion in the span of a generation. So here we have a situation where there's not too little labor, but there's too much. It really remains to be seen if these economies can generate jobs for that massively growing population. So that's certainly something we're watching going forward. If we move east, we look at Central and South Asia. This is the region dominated by India. India's been pretty disappointing. India is seen by many companies as the successor to China, as the main driver of global economic growth. But you see over the last 5 years, the Indian economy has just grown 4% per year. That's nowhere near where the expectations were of India not that long ago. Many economists thought India could grow 7 or 8% per year. It has not been able to do that for any sustained period of time. Now we expect growth to accelerate in the coming years to go above 6%, but that's still below the region's or the country's potential. And of note, of course, you may have heard this year, India has overtaken China to become the world's biggest country in terms of population. It is now, for the first time since the 17th century, more people live in India than anywhere else in the world. The population of India is approaching 1.5 billion people. It overtook China in part because the Chinese population is falling dramatically. In fact, we expect the working age population of China to fall by 200 million people over the next 30 years, which is just a dramatic factor facing the Chinese economy. We'll talk about that in a second. East Asia and Pacific, of course, this is the region that's been generating most of the growth for the global economy in recent years, really going back to the late 20th century. We're seeing slower growth in many parts of the region. There's a demographic crisis underway. There's the political tensions between China and a number of countries. A lot of the growth in this region is going to come from those emerging markets in Southeast Asia that have been growing rapidly in recent years, places like Vietnam, the Philippines, and Indonesia. That's certainly something to watch. This is, again, this is a region that is going to continue to generate a significant share of the additional economic output in the world. So what are some of the big issues that are driving the global economy? We touched upon some of these late last year. I want to go back and talk about some of them because we've seen since that time some actual evidence that these issues are in fact having a major long-term impact on the economy. The biggest one is demographics. So we talked about this in the past. the world population growth that it drove the global economy is coming to an end. As you can see from that chart at the bottom left there, we've seen a dramatic slowdown in global population growth. And this is happening with the exception of sub-Saharan Africa, where birth rates are also falling. We're seeing this is happening pretty much all over the world. And it's happening because people aren't having babies anymore. Birth rate has collapsed. The average woman in a country needs to have 2.1 babies in her lifetime to keep a country's population where it is now. And as you can see from that chart, pretty much every major economy has fallen below that 2.1 level. And there's been some data that's come out in the last couple of months which just shows how fast these birth rates are falling. Let me give you an example. South Korea, the average woman now has less than 0.8 babies. This is one of the most successful economies in the world, South Korea. They're going to run out of workers very fast because they have very little immigration. Their birth rate is collapsing, so less and less young people are entering the workforce. This is a huge challenge for the South Korean economy and many others. The Chinese economy, they recorded their lowest birth rate ever, and we believe they're exaggerating with the birth rate they're releasing. So we think the birth rate has fallen even further. Even in the United States always had a higher birth rate than most other rich countries. We've seen a significant decline in the birth rate in recent years. So this means less young people. So if you're in a business where your target market is young people, your market is shrinking. We've seen this happen in Japan and Italy. It's happening now in China. It's happening all over the world. So this is having a significant impact. And where it's having the biggest impact is on working age populations. We've seen a dramatic decline. I mentioned how China's working age population will shrink by almost 200 million people, almost 20% within a generation. How is the Chinese economy, which grew on the back of its unlimited workforce, going to continue to grow when the number of potential workers, the number of potential consumers is shrinking? And this is something the world needs to address. Now, of course, we'll talk about this in a little bit, technology may help us solve the supply side problem to this equation, but it's not going to help really solve the demand side. So that's something we're going to look at going forward. Of course, there is one segment of the population that's growing, and that is the over 65 segment of the population. 9% of the world's population today is over the age of 65. By the year 2050, 16% of the world's population will be over the age of 65. And in some countries, that number is much, much higher. Think of Japan, think of Germany, etc. Of course, this costs a lot of money. The cost of programs aimed at our over 65 population has soared from next to nothing 50 or 60 years ago to the leading or one of the leading categories of expenditure for governments around the world, and that's just going to continue to rise. So we need to find a way to make the over 65 segment more productive, or else this will be unsustainable. There is no way that these type of benefits will be sustainable for any government in the coming decades. We've seen some governments actually estimate how long it will be until they run out of money for their programs for their over 65 population. Some of them are suggesting that they only have 20 or 30 years left before they run out of funding for those programs. So that's a big issue going forward. Of course, this means immigration becomes the one potential answer. It's at least a short-term answer because there is population growth in some parts of the world still, but it's obviously a very hot button topic politically and not acceptable to certain segments of the population around the world. So whether or not immigration becomes the answer to this problem remains to be seen. It is a potential near-term answer, though long-term I doubt that it has the ability to have that big of an impact, but certainly it does over the near term. So demographically, we're in the middle of a population slowdown. This is having an impact on the young and the working age segments of the population. This is going to have a big impact on public finances and on the economy. And we need to extend the productive lives of people as they get older to offset some of the drag that this will have on the global economy.
And Michael, we've got our last poll question.
Right.
I've been talking a little bit about labor shortages. Our questions related to that. Have the average hours worked by your employees been affected over the past year? Got five different answers for you to choose from. We'll give you a minute or so to look those over and talk about the results. pretty evenly split there in the middle. Somewhat increased, unchanged, somewhat decreased.
That's interesting.
Any thoughts there, Michael?
Yeah, that is interesting. A lot of the clients that we deal with, they've talked about how they've had they're suffering from labor shortages, and a lot of people are finding that their workload has increased as they've been unable to bring in new people. So the decrease part, I suspect, could be because of the slowdown, simply as that there's just the amount of work has slowed a bit just because of the economic climate. The concern will be when the economy picks up, particularly in 2024, and those labor shortages persist. I think we'd see a different result on this question, as we'd see hours starting to work, the increased bit start to get a bigger share of the vote.
Thank you for that.
Okay, let's continue. So then there's a couple more things I want to talk about long-term before we get into the Q&A. I won't spend too much time on them, but I do want to talk about them. One, of course, is trade and investment. I'm not going to spend too much time here. Just the key thing to take away here is that we've seen a significant slowdown in global trade and global investment in recent years. This really goes back to the late 2000s, so about 2007, 2008 when this began. This continued really over that period. This has been a key driver of growth for many industries, for many countries, and the fact that we've seen a decline in trade and investment is disconcerting. Now, if we talk about, the one thing I do want to talk about, we've seen over the last 12 to 18 months a big surge in foreign investment into the United States. There's been a lot of concern in the manufacturing sector from companies outside of the US, concerned that they would be locked out of the US with the Inflation Reduction Act. So we've seen a major increase in investment. We're seeing companies thinking about reshoring because of this decoupling with China. So all of those factors have actually led, while much of the world is seeing a slowdown in foreign investment, the United States has actually done very well in terms of foreign investment over the last couple of years. And no matter what the situation, the US market just remains very attractive for companies outside of our region, and will continue to do so. A wealthy country of 335 million consumers is always going to be an attractive location for foreign investment. So while this is happening globally, certainly from the US perspective, investment has been relatively strong. What I do want to talk about is productivity. Productivity, I mentioned this in all my speeches, is the key to our future growth. We need to increase our rates of productivity growth if we're going to drive higher rates of economic growth. We've seen clearly that demographic growth is not going to be forthcoming. We see that trade and investment has been depressed on a global basis for about 15 years. Here's a segment where we can grow. And this is where, of course, a lot of focus has been on in 2023. Everybody's been testing AI and ChatGPT or Google Bard, whatever it may be, to see just how it can improve their productivity. And it remains to be seen if this will have an impact. We hope it does, obviously, because productivity has been declining in most of the world's big economies since the 1970s. We saw a little bit of an increase during the information revolution, but nothing like had been expected. Now we're hoping that perhaps AI and other technologies will lead to higher rates of productivity growth in the years to come, in the 2020s, in the 2030s. Some people have compared this to the next great revolution. Think about the agricultural revolution, the industrial revolution, perhaps the artificial intelligence revolution will be at such a scale. Other economists and historians will argue that we've heard this story before, and in fact, it'll have very little impact on productivity. I certainly think it can help us on the supply side. I think we can see an increase in productivity, but I think that it's not going to solve all of our economic slowdown concerns, let's say. And labor productivity, of course, declining significantly, as you can see among the four big developed economies there. One thing that is positive on the productivity side is that we've seen capital spending increase. Oh, by the way, since you're asking about hours worked per year, there's some statistics there just showing pre-pandemic levels of hours worked, just some of the changes we've seen. US hours relatively steady. We've seen a decline in working hours in places like Japan and France, even in Canada. That's for two reasons, essentially. One, the US economy has done better than those economies, so there's a higher demand for labor in the US. But two, unions have been stronger in those other parts of the world and have won major concessions, of course, for their workforce. So it's a combination of those two factors. I just thought I would follow up on that. We're running low on time, so let me go through this. I just want to say quickly, capital expenditure. We started to see an increase in some big countries in capital expenditure over the last 10 or 15 years. That's a really positive sign. That's something that could lead to higher productivity growth down the road. We'd seen capital expenditure in developed economies decline year after year going back to the 1970s. We're starting to see companies and industries realize they need to invest more in capital if they're going to boost productivity growth. I talked about new technologies. Artificial intelligence right now is everywhere. It's going to become more and more pervasive. What impact that will have on productivity remains to be seen, but it does have, at least it's given some hope that productivity growth can finally turn around after 40 or 50 years of steady decline. So the last thing I want to talk about then is the environment. Of course, the environment is having a big impact on economies all over the world. We're seeing this here in Ohio. We were covered in smoke thanks to Canada, the big wildfires in Canada, which are continuing. We're seeing natural disaster risk rise. We're seeing companies increasingly start to look at the environment when they're making investment decisions. So those regions of the world that can promise companies that they're more resilient to climate change and to environmental change are going to start to receive more investment, while other regions that are more susceptible to the impact of climate change and environmental degradation could suffer when it comes to being able to attract investment. So those, again, demographics, trade and investment, productivity, and the environment. Those are the four big factors that we need to look at when we're looking at the long-term future of the global economy. And it's really those last two where we have to make some major changes. Demographics, it's hard to change. Trade and investment, I think we've maximized our growth there. We need to focus on productivity, being more productive, and we need to focus on achieving growth in a more sustainable manner. So the summary, again, I've pretty much summed the key risks. Some of those near-term risks like labor shortage and inflation and high interest rates could persist a little bit longer than expected. Geopolitical tensions remain dangerously high, both internal political tensions, so internal divisions, and international relations. And these factors are going to make generating long-term economic growth, those combined with some of the other factors we talked about, more difficult. And that's a significant challenge. Now, opportunities, of course, we're seeing a reallocation of resources into more high growth sectors of the economy. That's a positive development. We hope for productivity breakthroughs like artificial intelligence, like 3D printing, et cetera. And new sectors of the economy have the potential to generate high rates of growth. Keep this in mind, 60% of jobs in the United States right now are jobs that did not exist in 1940. 60% of people are working in jobs that didn't exist just 83 years ago. With these new technological breakthroughs we're seeing, we could look forward to a future where there are jobs that we can't even imagine yet, but could be highly productive, can generate higher rates of growth for our economy. So that's something to consider as well. So there's my contact information. I'm going to take some questions now, obviously, but if anyone has any questions about ISA or about my presentation or anything that was in the presentation, that's how you can get in touch with me. You can connect with me on LinkedIn as well. I'd be happy to connect with you there as well. So if anyone has any questions, I will now stop sharing my screen and take any questions you may have.